You know, for years, whenever you talked about banking in India, one name always came up as the gold standard, HDFC Bank. It was the benchmark, right? The one everyone looked to for stability, for growth, for solid performance. But lately, something's felt a little off. The undisputed leader has been stumbling. So what is really going on? Let's get into it.
Okay, just take a look at this chart. It tells a really dramatic story, doesn't it? A story of a stock that's been under some serious pressure. The question on every single investor's mind is pretty simple. How did the gold standard suddenly become one of the market's biggest underperformers? Well, the answer isn't simple. It's actually a mix of global headwinds and some major internal struggles.
So first things first, let's zoom out and look at the big picture. Not everything that's affecting HDFC Bank is happening inside its own buildings. There are some really powerful global forces at play here, and they're hitting the entire Indian market. But since HDFC is such a heavyweight, it often feels the punch the hardest.
So here's the key takeaway. When geopolitical risk starts to rise around the world, big international investors get nervous. And what do? They pull their money out of markets like India and they run to so-called safe havens, things like gold or the US dollar. And which stock is often the very first one they sell? You guessed it, HDFC Bank, because it's one of the largest and most widely held stocks. Plus, all these conflicts push oil prices up, which leads to higher inflation and interest rates right here in India, making everything more expensive for banks to operate.
But honestly, these global pressures, that's only half the story. To really get what's going on, we have to look inside the bank itself. Specifically, at that massive merger with its parent company, HDFC Lid, back in 2023. This has created what a lot of people are calling a merger hangover.
The whole idea was to create this unstoppable financial behemoth, and in terms of sheer size, they totally succeeded. But this huge integration project came with equally huge and very complex side effects that have really shaken up the bank's finances. To understand this, we need to quickly get our heads around three key banking terms.
First up, we've got net interest margin, or NIM. The easiest way to think about this is it's the bank's core profit margin. It's the difference between the interest it earns on all its loans and the interest it has to pay out on deposits. So a higher NIM means a more profitable bank. Simple as that.
Next is the loan-to-deposit ratio, or LDR. This just shows how much money the bank is lending out compared to the money it has in deposits. If this number gets too high, it's a sign the bank is maybe a little overlent and it could struggle to fund new loans, which puts a real strain on its growth.
And finally, the CASA ratio. This one is super important. CASA stands for current and savings accounts. For a bank, this is the cheapest money they can get because they pay very little or sometimes no interest on these accounts. So a higher CASA ratio is fantastic. It means the bank has access to a ton of cheap money that it can then lend out at much higher rates.
Okay, now let's put it all together. This slide right here, this is the aha moment. Just look at these numbers. After the merger, their profitability, the NIM, got seriously squeezed. Their LDR shot up to pretty concerning levels, meaning they were lending out almost everything they had. And their access to that super valuable cheap money, the CASA ratio, dropped by a huge amount. It's basically a perfect storm of negative impacts, all coming from this one merger.
And this chart just drives home one of the core issues. That drop in the CASA ratio from 44% down to 34%, that is a massive deal. It means the bank's cost of finding money to lend went up, which directly hits its profits and makes it way harder to compete.
And of course, you know what happens when a giant is distracted, right? While HDFC Bank was completely buried in this massive, complex internal merger, its competitors, well, they weren't just sitting around and waiting. They were making moves.
So rivals like ICICI Bank and Axis Bank were way more nimble during this whole period. They totally seized the opportunity, pushing aggressively into high-growth areas and, in a lot of cases, were showing better results. This made some big investors start to shift their preferences, which just added even more pressure on HDFC's stock.
All right, so that's the diagnosis. But what about the cure? What is HDFC Bank actually doing to fix these problems, and what should we be looking for as signs of a turnaround?
Before we dive into their strategy, let's clear up a quick technical point that made that stock chart look way more dramatic than it actually was. I'm talking about the bonus share issue back in 2025.
Okay, so in August 2025, the bank did a 1-for-1 bonus share. All that means is if you owned one share, you got another one for free. Now, since this instantly doubles the number of shares out there, the price of each share automatically gets cut in half. So a stock that was at 1,800 rupees would suddenly show up as 900. The crucial thing to remember is the total value of your investment didn't change at all. It was just a technical adjustment, not a 50% crash in value.
So with that technical point out of the way, let's look at what the bank has been doing recently. By March of 2026, the bank really started to fight back, and fight back aggressively. And here is their first big public countermove. On March 6, 2026, they hiked the interest rates on their fixed deposits. So why is this so important? Well, it's a direct attack on their biggest problems. By offering better rates, they're hoping to attract a flood of new deposits from people like you and me. This will help bring down that dangerously high loan-to-deposit ratio and give them the fuel they need for future growth.
And that really brings us to where we are today. This quote just sums it up perfectly. The entire market is basically holding its breath and watching one thing. Can HDFC Bank bring in more money through deposits than it's lending out? That is the ultimate test of their recovery.
So, HDFC Bank is at a massive crossroads. It's this giant, grappling with the aftermath of its own huge ambition, all while trying to navigate a pretty stormy global sea. We can see they're taking clear, decisive steps to right the ship. But the big question remains, will it be enough to win back the market's trust and reclaim its title as the gold standard of Indian banking? The market, and all of us, are watching.